Everybody see the investing basics title slide?
Yes, we can.
Just share with you.
Yes.
Okay.
Yes.
All right. Thank you. So let's see here. All right. So this is the outline of this webinar. Introduction. We're not going to spend too much time on that because we already kind of know who is on, who is not. And then we're going to go to the plan, selecting how we go about selecting our investments, protecting our investments, then some do's and don'ts, and then how do we put it all to practice. So as you can see, there's a lot packed into this. It may feel like you are drinking from a fire hose because I'm going to give you a lot of information today. But don't let that's part of why I want to have the meeting recorded so people can watch it maybe more slowly, but that's what we have. So it's jam-packed, and so let's get going. Again, I think everybody is already doing what we asked them to do, which is keep your microphone on the mute. Only when you want to ask questions, please use the raise a hand so that I can see that I can get your attention, or get my attention, and I call on you. You can ask your questions, and then remember to mute yourself again once you are no longer speaking. So that's just the protocol. Webinar tips. I have taught this class to adult students. I taught it for many years in a community school here. And what I found is the more people participate, the more they get out of it. There are no such things as stupid questions. By the way, let me give credit to my holding this webinar, came from my, discussions with Shegi and Ronke. When I will talk to them, they will ask me questions having to do with investments. And then it occurred to me, I said, wait a minute, if they're asking these questions, there are probably other people who have similar questions. And hey, I already taught this course. Why not have it for friends and family? So that's how this came about. So kudos to Ronke and Shegi. All right. So in terms of introduction, like I said, we won't spend too much time on it. Most of you already know me. I run an ETF Foundation, and our mission is empowering African youths. We operate in at least 20 different African countries. Again, many of you are familiar with what we do. So we're not going to spend time on that. But let me just give you a little bit of my background, just so you know how I got to giving this course. After I did my bachelor's in the UK, and then I came to MIT for graduate studies at MIT Plasma Fusion Center in Cambridge, Massachusetts. And my specialty was superconductor magnets, which is what is shown here. There is a Fermi lab, a national lab near Chicago, run by the US Department of Energy. I used to do my experiments there on superconductor magnets. What you are looking at here is a ring. It's about 5 meters diameter, and there are 1,000 superconductor magnets that line it underground. So I used to study them. I would travel from Boston to Chicago, collect data, and come back. So that's what I did for graduate work. And when I graduated, I went to work for GE Healthcare in Florence, South Carolina. Kem is supposed to join us. That was where I met Kem. Kem is my very, very good friend. So hopefully he will join us a bit later on as well. And then I came up back north to work for a company called American Superconductor. And this motor was the biggest program I handled. It was a $100 million program for the US Navy. And we delivered the motor to the naval shipyard in Philadelphia. And then my last stint was at Medium Medical Systems, where we built this cyclotron. It's meant for treating cancer. So we have a superconducting cyclotron inside it, and I was the leader of the group that developed this superconductor magnet. So again, I'm not going to spend. You guys already know, to a large extent, you know each other. So we're not going to spend too much time on that. We're going to proceed. I'm required to give you this disclaimer. What all it says is that what I'm going to give you today is for your own education, and it's not. I'm not endorsing your buying particular products. Your investments are your decisions. So all this is for your own education. All right, let's get something right off the bat. This course will not teach you how to get rich overnight. I don't know how to do that. So instead, what I'm hoping to do today is provide some tools that will be useful for you as a long-term investor in terms of building real wealth over time. So the key word here is long-term investing. So part of the reason I gave you my background is to know how I came about this course. Basically, at some point, I realized that a lot of the things I learned the hard way as I was going through the ranks. So as I mentioned, I work for GE, which is a Fortune 500 company, but I also work for startup companies. So I have a wide range of experience working for various companies. And when I originally put this course together, maybe maybe 8 or even 10 years ago, the goal was to capture all the things, the hard lessons that I learned, and give it. I just realized I need to fix something on in my video here. Just give me a second, and I'll be right back with you. Let's go to the mirror mode, and that should fix it. Oops, that's not good. All right, there we go. All right, I'm back. Okay, so that's the how I came about this course. It's basically the lessons that I learned through my career in various companies. One of the students I taught described my course as "Get Rich Slowly," and I think it kind of captures what I'm going to present to you today. All right, let's move on to the next slide. I usually go through a poll here with some of the, let's see if I can maximize this. We're just going to do a rough poll. So I have this question for all of you. I'm a long-term investor. How frequently should I check my portfolio? I'm going to, mention each one of them. Let me just make sure I can see you all before I can't quite see everybody. So it may be difficult to eat all that. Oh, I think what I need to do is I need to stop sharing first. So let me do the poll. So I'm going to ask you, for each one of you, how frequently should I check my portfolio? Okay. Is it as frequently as I can on my mobile phone? If you can show by a raise of your hands. Okay, anybody? I don't see anybody. Okay, daily? I don't see. And weekly?
One person did. One
Oh,
person raised their hand.
one person did. Thank you, thank you, Ronke.
Yeah.
One person did for daily.
Yeah, I think Mr. Wale allowed.
Okay, thank you. All right, so daily. Let me just get this down. A, B, C, D, F. So that is one. And for weekly, how many people think weekly? Okay, thank you, Daddy Tosin. He raised his hand. So actually, if you can use your raise your hand, that will help me better. So he used the raise your hand symbol. So we have one there. Anybody else? Okay. And so we are good to go. Next one is monthly. Again, just okay. I see one. Thank you. That Ibukun raised a hand. That's one. And nobody, anybody else? No. Quarterly. Okay, I see Ronke raise her hand. Anybody else? So that's one. And yearly. Ronke, you can drop your hand. Okay, I see Isabel, Lukman. That's two. That's two. Anybody else? And Shaggy. Yeah, that makes 3-0. All right, very good. I think we got it. So I'm going to ask you this same question at the end of the webinar, and then we'll see what you answer. All right. So let me go back to sharing my slides, and it's going to be here, right there. Make sure people can see it again. All right. Can everybody see my slides? Just show by raising your hand. Thank you. All right. Okay. You can all put your hands down. All right. So let's move on to the next slide. So there are 3 major segments to this webinar. The first part is where we just go through the basics and the definitions, because it's important for us to be speaking, as one of my colleagues used to say, to be singing from the same hymnal. In other words, we need to be on the same page when we use this terminology. So we're going to be talking basics, definitions. And then the second part is where I will go through the rules and the tools you need for investing. And finally, the third part is the application. How do you put it all together? And Shaggy, you can put your hand down. Your hand is still showing. Yeah, thank you. Up, looks like she disappeared. I hope she's still with us. All right. So that's the format. So let's go through it. Now, before you invest, as you know, as the saying goes, you need to learn to crawl before you can walk and before you can run. So there are certain things you need to take care of before looking into investing. One is make sure you have an emergency fund. And again, there are no hard rules on this, okay? It's kind of up to the individual. But some people will say have at least 2 months of spending put aside. Other people will say it's 6 months. That's okay. You can just make your own mind what it is and stick to it. And of course, make sure you have adequate insurance coverage for catastrophic events. If you have a house, make sure your house is insured. If you rent, make sure your rental properties in your apartment are insured as well. And then number 3, make sure you can meet your housing needs, whether it is a rent or mortgage. And number 4, which I think is the more important, is make sure you've paid down your heavy debts. And by this, I'm talking of high interest rate credit cards. So here is the thing. If you're going to be investing, if you're already paying like 15% for a credit card, there's no investment that you go to make that is going to compensate for that. So you are better off making sure you settle your debt. And again, we're not saying you cannot use credit card. You can use credit card, but as long as you pay your balance, you're in good shape. But if you have high interest rate cards, make sure they are paid off before you start to put these in investments. Okay. Again, feel free to raise a hand if you have a question. Okay, and I will call on you. All right, here is one some people will find it stunning. Do you know that 9 out of people who invest, who call themselves investors, they don't make any money? You know, they're either losing money, or if they are lucky, they are just, managing not to lose money. That is, this fact has not changed for decades. And so what I'm hoping I will give to you today are tools to move you from this yellow people to the green person. So that's the idea behind this course. So the first thing we want to do is let's examine what are the alternative investments at our disposal. There are really 3 broad categories of investments: fixed income, otherwise known as debt instruments, equity, and tangible assets. We're going to go through each of them one by one. By the way, you notice here that real estate is not among them. And the reason it's not there is because it's not a separate class by itself. Real estate can consist of equity when you directly own property, or fixed income. So that's why it's not listed among the broad categories. So let's get started with fixed income. Fixed income includes things such as cash and cash equivalents, certificates of deposits, treasury bills, and bonds. Cash equivalents will refer to things that are very liquid. When you say something is liquid in financial lingo, it means you can readily access it. So things such as bank accounts, bank savings accounts, checking accounts, money market, they are all cash equivalent. And then the next one is CDs, or certificates of deposits. This is where you give money to the bank for a certain length of time, and after that you collect some interest. Here is an example from one of the ads in our local newspaper here. So in this case, they are advertising a 19-month CD. So at the end of it, they will give you 2.19% interest on it. Okay, again, it will vary depending on the prevalent interest rates at the time. Okay. All right. So next, let's go on to treasury bills. So treasury bills are issued by the US Treasury, okay, and they are for up to 1 year. So it's a debt of the of obligation of the United States. And then we go and move on to bonds. Bonds are longer terms. In other words, anything longer than 1 year. They could be as long as 3 years, some of them 10 years. So those are all fixed income. Okay, so these are all we have for fixed income. The next category is equity, which is stocks. And this is what many people think of when they think of investments. Really, when you talk of stocks, it's all about joining with other people to finance a business, by buying shares in a company. So, for example, the companies we are talking about have to be companies that are publicly listed, okay, in one of the exchanges. Private companies, you cannot not own shares in them, but public companies, you can. The way we quantify companies is by capitalization. Capitalization basically is the number of shares outstanding by a company multiplied by their price per share. So, for example, a company that is valued at $10 a share, if they have 10 million outstanding shares, their capitalization will be $100 million. Okay. So, with this capitalization in mind, companies are categorized according to their capitalization. There are large companies, stocks. And by the way, when we're talking of stocks, we are usually, at least for the purpose of this webinar, we'll be talking of US stocks. By the way, Daddy and Mommy Tosin, I have a few slides. I hope you'll be able to hang around. I have a few slides towards the end that addresses, Canadians investing in the US stock market. So, but that's later on.
Okay.
So anyway, but in terms generally, when we're talking of US stocks. Large company are companies that have capitalization that are bigger than $10 billion. So these are usually companies you will know about. Companies like Walmart, Amazon, Apple, Johnson & Johnson. So these are big companies, okay? And they are traded mainly on the New York Stock Exchange. So these are large companies. The next categories are medium-sized companies, okay? These ones, you may not even have heard of them. Their names may sound strange to you. So their capitalization is between $2 and $10 billion. And then finally, we have small company stocks, those whose valuation is less than $2 billion. And the thing with small company stocks is over the long term, on average, they tend to perform better than larger stocks. But at the same time, they also have higher risks. In other words, they tend to fluctuate more rapidly than larger stocks. My analogy with people is that large stocks, they are like those trailers. We call them trailers. They call them semis here. It's like those semis that you see, on the highway. As you know, they tend to move more slowly. Whereas small company stocks, they are like sports car. Think of a Ferrari. That's small company stocks. But as you know, with a sports car, if you're not careful, you could crash. So that's the same thing with small company stocks. They are very fast, but they can also crash and burn. So you just have to keep that in mind. And then finally, we have international stocks. This is where we put all, companies that are traded outside, or they have their home base outside the United States. A couple of examples will be Schlumberger, Mercedes, so these are companies, they may be based in Europe, they may be based in Japan, they may be based in China. Sorry about that. So there you have it in terms of equity stocks: large, medium, small, and international stocks. Finally, in terms of broad categories, the last category is tangible assets. Tangible assets means stuff you can touch with your hands, your physical stuff, like gold. If you have some gold bullions, that will be tangible assets. Platinum, rare coins, diamonds, even works of art, those all qualify. So there you have it. Those are your broad categories of investments. And so at this point, does anybody have any questions? All right, good. So we're going to proceed then with the next slide. Now that we know the broad categories, the next question is, how do we invest in them? Mutual fund is a company that they pull money from many investors, and then they use that money to invest in securities like stocks, bonds, and even short-term debt. So because they have money from many people, they can afford to put their money in many different companies. So that's what mutual fund is. Just like with companies, mutual funds have different categories. Small and aggressive growth funds, they tend to invest in smaller companies. Growth funds invest in large cap companies. Okay. Growth and income, they will invest in both stocks as well as fixed assets. Okay. And international funds, as their name implies, they invest internationally. And then there are other funds. We're not going to spend time on these ones. And then bond funds. Bond funds also come in different categories. They are long-term, they are short-term, medium-term, and then there are municipal bonds, such as are issued by cities. Corporate bond funds issued by companies, and then government bond funds issued by United States government. And then there are also international bond funds. Okay. So the next thing is let's define a market index. A market index is a hypothetical portfolio now of investment holdings that represent a segment of the financial market. The key word here is it is hypothetical. Okay. Now let's go. Let me give you some examples. I'm sure all of you have heard of the Dow Jones Industrial Average. Okay. This is an index of the 30 largest companies in the United States. Okay. And then the next one is S&P 500, which is 500 of the largest companies in the United States. Then there is Wilshire 5000. Don't let the name deceive you. Even though it says 5,000, it's actually all publicly traded companies in the United States. So these are all reflected in the Wilshire 5000 index. Then the NASDAQ. The NASDAQ is a tech exchange. So it features many high-tech companies and biotech companies. And then finally, Russell 2K is for the small company stock. It features the 2,000 smallest companies in the United States. So all these indexes, they are hypothetical. Hypothetical in the sense that you can say, I want to buy the Dow Jones Industrials. Nobody owns the Dow Jones Industrial Average. But I will show you later on how you can invest in the Dow Jones if that is what you choose. Okay. But these are the market indexes. Now, the next thing is we need to know that there are ticker symbols. Okay. Ticker symbol is simply a unique series of letters that are assigned to any security that is traded. All right. Let me just give you some examples here. Apple Corporation, their ticker symbol is AAPL. So what it means is that if you, from the comfort of your home, you have a brokerage company and you tell them, I want to buy AAPL. From anywhere around the world, everybody knows you are talking of Apple. Same thing with Amazon. Amazon is AMZN. That symbol is used throughout the world. And then Walmart is WMT. Johnson & Johnson is JNJ. So any instrument that is traded on the stock market has its own ticker symbol, and that's all you need to trade it. The next thing we need to define is ETF. ETF, or exchange traded fund, is a marketable security that tracks an index or a commodity or bonds or a basket of assets. Remember how I told you can't invest in the Dow Jones Industrial? ETFs allow you to invest in those indexes. I think I have some. Yeah, here are some examples. So, for example, if you wanted to invest in Dow Jones Industrial, there is an ETF whose ticker symbol is DIA. I call it DIA. All you need to do is put your money in DIA and you will be invested in the Dow Jones Industrial Average. Same thing. If you want to invest in S&P 500, there is an ETF named SPY, and all you need to do is buy SPY, and you'll be invested in 500 of the largest companies in the United States. Same thing, if your preference is for smaller stocks, all you have to do is buy IWM, and you will be invested in the smaller stocks. Same thing, if you would like to invest in Europe, EFA is the way to go. If you want to invest in Asia, Latin America, and yes, Asia, Latin America, and Africa, EEM allows you to do that. And then if you want to invest in bonds generally, bonds, the Vanguard has a very good bond fund called BND. It's, as the name implies, it's total bond market. So these are ETF examples that allow you to participate in the in both the stock market as well as the fixed asset markets. So let me summarize what I know I went at blistering pace, but the bottom line is we've gone through the various broad assets that we can invest in: stocks, bonds, and cash instruments. And then we've also gone through mutual funds, which allow us to invest in any of these. But not just with mutual funds, we can also use ETFs, or exchange traded funds, to invest in stocks or bonds or cash. Any questions so far? All right, so we're going to proceed. The next topics I'm going to discuss is where I go through the rules of investing, and also I'm going to present to you some historical returns. So if you're going to play any game, you got to know the rules. The same thing with investing. So there are 6 rules I'm going to give you. The first one is, make sure you have clear-cut objectives and a realistic plan to get there. We often talk in terms of SMART objectives. Okay, SMART is short for specific, measurable, achievable, relevant, and time-based. Okay, the best way to illustrate this is with some examples. Here are some SMART objectives. I want to finance college costs of $40,000 a year for each of 4 years, starting in 15 years. It has cost, it is measurable, and it has time. Number 2, retire in 30 years at age 65 with $1 million. Again, it's got some quantity associated with it, and it's got time. And then this third one, provide an income starting at $100,000 a year, beginning in 30 years and lasting for a 20-year period. What all these 3 have in common is that they are quantifiable in terms of amount, and there is some time, associated with them. On the other hand, let me show you some non-SMART examples. Make as much money as possible. What is as much money? I don't know. Become rich. What do you mean by rich? Become wealthy. Live comfortably in retirement. I mean, live comfortably. Are you talking of live comfortably in the United States, or live comfortably in an island in the Caribbean? I mean, so what these have in common is these are non-SMART objectives. They don't have all the attributes. So you get the idea. So make your, so rule number 1 is make sure you have quantifiable objectives. Rule number 2 is make sure you have a correctly balanced portfolio. And we're going to talk more about this later on, how you go about doing that. The reality is that based on many studies that have been done, how you allocate your assets is going to be your most important investment decision. How you allocate your assets. And again, I will give you some guidelines on how you do that later on. Rule number 3, ensure you have adequate diversification of stocks. Note that it states specifically stocks. And the reason is that stocks are much more volatile than other types of investments. For example, if you have bonds, a bond isn't going to, suddenly crash and become zero the next day. A stock can do that. By the way, it's happened to me. The stock you buy, suddenly they just, if the company just, they go belly up, your stock is going to be worth nothing. So that is why if you are invested in stocks, you make sure you are diversified. Now, diversification means that you own assets in different types of stocks, so that if one is, going up, the other is coming down. Think of it like a yin yang. Okay, so that way, if one of them is, is not doing too well, the other one hopefully is doing better. So that's the whole idea of diversification. Rule number 4, match your investments to your risk tolerance. Okay, and we're going to talk a little bit about risk later on. Now, and number 5, let your time horizon dictate your investment vehicles. Okay. Rule number 6, exploit the power of compounding. Exploit the power of compounding. Now, this one, I often like to refer to this as the 8th wonder of the world, or the best kept secret in investing. Let's see what I mean. Here is the magic of compounding. So this is just an example. Suppose you have $1,000 to invest. Okay, $1,000. That's how much money you have, and you put it in compound interest at 10% for 20 years. Now, the interest you will earn on your original principal is going to be about $2,000, which is not chicken feed. Okay, but by leaving all your interest in and allow those interests to also earn interest, guess what? Your $1,000 is going to be worth over $7,000. That is the beauty of compound interest. Okay. So another analogy I give to people is compound, think of this bucket on the left hand. It's, you fill it with water and the water stays in. On the other hand, the one on the right, it's got some leaks in it. And what happens? It's not going to fill up. So by leaving your interest in, you are, basically using your investment just like the bucket on the left. So think of that when you're thinking of compound interest. But here is a much more vivid example of what compound interest does. All right. This is a snapshot of what $100 invested in the stock market over 80 years of the stock market will have done. Okay. So the blue one here is what, by the way, here stocks during this interval appreciated by about 10%, bonds about 5%, and short-term instruments is about 3%. When you look at those numbers, you will say, well, they are not far from each other. But when you compound those interests, you'll be amazed what a difference they make. So here you go. The stocks, when you put those just $100 in stock over these 80 years, when you are done, you have about $250,000. Okay. Whereas with bonds, which is at 5%, it's not shabby, but guess what you end up with? Just over $10,000. I mean, that is remarkable. And then with short-term instrument, you get even less. And of course, remember, inflation is always behind the scene. So this gives you the power of compounding. And what you want to do is use the power of compounding to your advantage. Okay. So there you have it. Those are your 6 basic rules of investing. Having clear-cut objectives, smart objectives, balanced portfolio, diversify, match your risk tolerance, let your time horizon dictate your investment vehicles, and finally exploit the power of compounding. Any questions at this point on any of this stuff I've presented so far? All right. So we're going to keep moving on. Now, how do you, we've talked about all these investors. How do you select them? So that's the next segment. When I was working for American Superconductor, we had a mantra. It said, in God we trust, all others bring data. So I'm not going to tell you to trust me today. I'm going to show you the data that led me to the conclusions that I'm going to give you. All right, so let's go. So the question we want to ask is, how have different investments performed over time? Okay. For the benchmarks, we're going to be using the S&P 500. By the way, many people, including me, believe that the best index of the US stock market is the S&P 500. It's not the Dow Jones. The Dow Jones is 30 companies. The S&P 500 is 500 companies. That is why I believe it's the best. So that's what when I talk of the stock market, I'm referring to S&P 500. And then bonds, we're going to be going with the intermediate term. And then finally, cash, US Treasury bills. So those are the benchmarks. So here is a graph of how the stock market, again, the S&P 500 index has behaved, going back to 1985. So what you can see is that to a large extent, it's going up, from time to time. There's Black Monday there, Gulf War, it will come down. And then we had the dot-com bust of 2000, in which it had a significant come down. But then it resumed again. And then the 2008 financial crisis came down again. And then it resumed. And then we had coronavirus. Again, a very sharp drop, but just as quickly as it dropped, it recovered. Never happened before. So the picture I want you to take from this graph is that over the long run, the stock market is usually moving up. But if you take a snapshot over a short term, the market can drop significantly. So let's look at some numbers. So the return on stocks from 1928 to 2024 is about just over 10%. Bonds, just about 5%, and cash, 3 or 4%. Okay. So when you look at this, you say to yourself, of course, stocks are the way to go. They beat everybody by a large margin. Next slide. Now let's look at the returns over 1 year period, 5-year period, 10-year period, and 20-year period. Okay. When you look at that again, what you discover is, again, stocks are by far the winner. In 1 year, sometimes the stock market has appreciated by 50%. Now, does it do that every time? No, but it's capable of doing that. Even over the 5-year period, it's better than all the other investments. So if you look at this chart, you say to yourself, why in the world will anybody want to invest in anything but stocks? Well, the answer is on the next slide. So these are your worst return. Your worst return. Now, remember how stock was beating all the other guys in all the various periods? Look at the 1 year period here. You could lose up to 40% of the value of your investment if you are invested in stocks. That is a lot of money. Whereas the other, bonds and others, they have much better performance. So let's quantify it. So if you put your money in stocks, again, remember we're talking of the worst. I'm not saying this is exactly what's going to happen to you, but you got to be prepared for something like this to happen. So over 1 year, if you put $1,000 in, your $1,000 could go down to $600. And if you put $10,000 in, your $10,000 could go down to $6,000. So, I mean, I don't know about you, but I would not feel good, putting my money in something that can fluctuate this rapidly. On the other hand, see what happens if you put your money in stocks for 5 years. Now, again, remember, we're talking of what is the worst possible thing that can happen to your money. In this case, your $1,000 could now be $960. In other words, you lose $40. Who cares? That is chicken feed. Same thing, if you put $10,000 in, the worst that can happen to you over 5 years is that you lose $400. Again, who cares? The point of my giving you this slide is that when you invest on the long run, the stock market is the place to be. On the short term, no. In fact, I will put it more strongly. If you are thinking of money that you're going to be needing in less than 5 years, don't even think of the stock market. Again, you could get lucky, but you know what? I don't believe in gambling. So, I wouldn't risk my money. So now, when we go to 10-year periods, things start to get even better for stocks. Look at this now. Now you are even losing less than 1%. And guess what? When you go to 20 years with stocks, not only, and remember we're talking of your worst outcome, not only are you not going to lose money, your stock is going to outperform every other instrument we talked about. That's over 20 years. Let's put some numbers to this. So if you put your money in stocks over 10 years, again, I want to remind you, we are talking of the worst that can happen to you. The worst over 10 years is that you lose $20. Okay? Who cares? Same thing. If you put $10,000 in, you lose $200. Not a big deal. But if you put your money there for 20 years, not only the chances of your losing money on the stock market over 20 years is next to nothing. Most likely you're going to be making some money. Remember, we are talking of the worst outcome. We're not talking, in most cases you will do better than this. But the reason I'm giving you this, so you know the risk that you are taking. So I just mentioned risk. So now it's a good time to talk about risk. Here is the risk profile of the various instruments we're talking about. Okay. On this chart, on the lower axis here is the level of risk. So lower risk is on the left, higher risk is on the right. The return is on the vertical axis. So again, lower return is on the bottom, and at the top is higher returns. What you will see here is that the S&P 500 is kind of in the middle right there. And that is why you want to be in the S&P 500 for a big portion of your long-term investment. You see, treasury bills, they don't yield much, but they are very safe. Treasury bill is like putting money under your mattress. Of course, it's going to be safe, but you're also not going to have any significant return. And then you go into money market funds, and then bond funds, and then stock, which is growth funds, and then you go to very aggressive funds. So this is the risk profile you need to keep in mind as you invest. Okay. So let's summarize what we've just gone through. I know I went at a blistering pace, but here is the bottom line. Stock returns are much higher than bonds or cash on the long run, anything over 5 years. Stocks carry higher risk of loss than bonds on cash if you are investing in less than 5 years. So any questions at this point? I know I've dumped a lot of materials on you, but please feel free to ask if something is not clear. All right, we're going to move on then to mutual funds and ETFs. Okay, Shegi has a question, so I'm going to let Shegi ask her question. Go ahead, Shegi.
Yes. Are there companies that consistently grow and yield better return? I know that we've just spoken about the 500 companies, but are there particular industries that constantly, continuously make better returns among them?
Okay, so thank you, Shegi. That's an excellent question. Yeah. Actually, there is a slide that I would when I taught this class in the regular class, I had it in there, but for this class, I took it out. And the reason is that we have a shorter time to go through these things. But let me answer Shegi's question. The answer is yes. So the S&P 500 that we're talking about, which consists of all 500 of the largest companies, there are what we call sectors of the market. There are like, I think, 11 or 13 different sectors. They include technology, communications, energy, healthcare, utilities, finance. So those are all the different sectors. Over the years, the sectors that has yielded the most is technology. Technology leads everybody by far. Now, just as I mentioned before, as it leads by far, it also is subject to more fluctuations. So the short answer, Shegi, is that yes, there are industries that tend to lead better, and those are technology, the technology industries, but they also tend to be more volatile. Did I answer your question, Shegi?
Yes, you did. And I just want to add that in Nigeria, for example, the industry that is constantly, making higher return is the brewery.
Oh,
alcohol.
Yeah, that is interesting.
Not so much technology, but alcohol.
But alcohol.
Because of the state of the country, everybody kind
of people want to drink.
Yeah.
Exactly. Yeah. No, that's a good point, and that's a good point. Thank you.
But again, this is a technology for the stomach.
Yes, exactly. That's I like that, Martin. That's technology for the stomach. That's a good way to put it. Yes. Yeah. So as far as US stocks go, it's technology that leads. And okay. Any other questions before we move on? All right. Thank you. So mutual funds, as we've already defined this as a company that allows many investors to pool all their money together, and they invest it in many companies. Okay. Now, here are some mutual funds that I think I've invested in some of them at some point in the past. At this point, when I taught this course, okay, sorry about that. So I used to also go through the steps involved in choosing a mutual fund. I decided to take those slides off this year. The reason is going to become clear to you a little bit later on. So ETFs, we've already talked about ETFs. They are exchange traded funds that allow you to track an index a commodity, or even bonds, okay, or an index fund. And I already gave you this example of ETFs, these examples. I'm going to tell you something right now. This list that you have here of 6 ETFs, I'm willing to tell you that most people will benefit. In other words, these should be good for more than 90% of your investments. They cover all the territory. Okay? There is SPY, which represents all the 500 stocks of the largest stocks. There is DIA, which is industrials, and so on and so forth. I'm not going to go through all of them, but you will discover that you can make most of your investments with any of these instruments. Okay? And I will go even further. The more instruments you try to use, usually the more money you're going to lose. You make your investments complicated, you lose money. Okay? So in terms of choosing which index funds you want to use, you just need to determine which index you want. If it's S&P 500, it's SPY. If it's the Dow Jones you want, it's DIA. And go with the principle of KISS. Keep it safe and simple. Actually, my former boss used to call that keep it simple, stupid. Okay, whichever way you look at it, don't make your investment too complicated. And then then all you have to do is check that your index is matching the performance of. Okay, it looks like Jumoke just joined. All right, hello Jumoke. Okay, all right, she's now with us. Very good. So you want to make sure it's matching its funds. A high turnover ratio, you actually don't have to worry about that if you are in ETFs, because they tend to be low turnover. And finally, you are not trying to beat the market. Many people will tell you they can beat the market. Believe me, they really do, even the professionals. So how come you as an individual, you think you're going to beat the market? You're kidding yourself. So you don't expect to beat the market. You own the market. That's how you trade index funds. So remember I mentioned earlier that I skipped my mutual fund slides. This is why I skipped them. You see, ETFs, they are much simpler. They are much simpler to use. And secondly, they have lower cost. I think I have a chart for that. Look at this chart. You can see here that mutual funds, their cost is more than 4 times what you're going to be paying for ETF. Why throw away your money? Why throw away your money? That's what you do if you put in mutual funds instead of ETFs. Okay? So, lower cost, less taxes. If you make capital gains, you'll be taxed on your capital gain. And we're going to talk about that later on, okay? But ETFs, because they are passively managed, you don't have to worry about those capital gains as much. And they also require less time to manage. When you're going to invest in mutual funds, you have to do a lot of research before you select your mutual funds. Okay, so those are the reasons why I advocate putting money in ETFs as opposed to mutual funds. And you can see here from the growth of mutual funds over the years that it is basically eclipsing mutual funds. ETFs are eclipsing mutual funds to the point now that more than 70% of all instruments available for investing in are now ETFs versus 30% for mutual funds. Again, this graph shows you the same thing. More money is flowing into ETFs, whereas money is flowing out of mutual funds. So here is a summary of what I just went rapidly through. If you can meet your allocation with index funds, by the way, I use the term index funds and ETFs interchangeably. Okay, to me they are the same thing. So if you can meet your asset allocation with ETFs, do it. If not, you can always consider mutual funds. However, I can't overemphasize this. Leave individual stocks to professionals and individuals with a lot of time to waste and a lot of money to lose. That is the final conclusion I'm giving you here. Now, question. All right, Daddy Tosin, you have a question.
Yes.
Yes.
Thank you very much so far. And the good thing about it is that we can go back to the lecture after this session. So yes. I remember initially you mentioned the reason why real estate is not a good. I'm not sure if that's the way to put it.
Actually, I said it's not on the board now. Yeah, it's not one of the broad assets. That's what I said. Yeah.
Because I know stocks returns are much higher than bonds or cash on the long run, and that stocks carry higher risk or loss than the bonds or in the short run, right?
That's right.
I'm just wondering. I want to believe that real estate investment, might eventually, on the long run, bring in more profit than bonds and mutual funds and all this. I know it's more a long-term investment than money market.
Yes, that is Tosin, you are exactly right.
Okay.
And in fact, I have a friend who is in, he's the real estate guy, and he asked me questions about investment. So again, if you own property, you actually have equity. So indirectly, it is equity. It's not stock, but you have equity. When you have owned a property long enough, it becomes equity. So when I didn't discount it that real estate is not a good investment, all I was saying is that you need to categorize it as either equity or fixed income. Does that make sense?
Yeah, it does. It does. I remember you mentioned something like that initially, so I wasn't sure what exactly you meant. Because
go ahead. Yeah.
Sorry, because I have had discussions with some of my investors, and my argument is that I would rather invest in real estate than mutual funds or stocks. And
I see.
And the argument he puts up is exactly what you're saying now, that it's more, it's like an equity. You can get equity on it, but where would you put that equity? You can't just keep the money there and just grow. You need to invest it in some other items.
Yeah, exactly. So real estate, again, this in the United States, it has appreciated a lot. And so if you own property, your equity is going to be growing over time. Okay. So but again, you just have to manage whatever properties you have. It's not a one size fits all. You can do both. And Shaggy is raising before I come to you, Shaggy, let me Daddy Tosin, did I answer your question?
Yes, you did. Yes, you did. I just wanted some clarifications, and you did. Thank you.
So, all right, no problem. Shaggy, go ahead.
Actually, I didn't know that I raised my hand, but since I'm in, let me just ask the last slide that we just discussed.
Yes.
The last sentence is leave individual stock to professionals and individuals with a lot of time to waste and money to lose. That's scary. Can you please elaborate on that?
Okay. So what I mean is that, you see, when you buy an individual stock, okay, that stocks have so many variables that it is difficult to predict what they're going to do. Okay, let me give you an example. Every stock that is listed in the United States, they have to publish their earnings quarterly. Every quarter, they have to publish their earnings. Now, usually they will predict what they expect to make. They may say something like, we're going to make 10 cents on every share. Okay. Now, if a company says they're going to make, say, 10 cents, and they release their results, and they make 9 cents, do you know what's going to happen to that stock? It will get clobbered the following day, just because they will say they missed their earnings, even if it's 1 penny. Okay, so that's just an example. The point is that individual stocks, they vary so rapidly that most individuals, they don't have either the resources or the time to keep track of these individual stocks. But why do that when you can just put your money in an ETF that is going to be tracking these stocks? You follow me, Shaggy?
Yeah.
So the point is that it's not that you shouldn't put money in stocks, but put it in an ETF that owns many stocks, so that you're not putting it into a single stock that can belly up overnight. Again, what I'm telling you, Shaggy, has happened to me. I have lost 100% of what I put in the stock because the company went belly up. So this is not arbitrary. So that is the risk you take when you put money on individual stocks. But when you put it in an ETF or even a mutual fund that owns many stocks, even if one of them goes belly up, maybe you will lose 5%, but losing 5% is a lot different than losing 100%. Does that make sense, Shaggy?
It does. Yes, it does.
All right, thank you. All right. Any other questions before we proceed? Okay, thank you. All right. So we've talked about, the various instruments. The next thing is protecting our investments. And then I'm going to go through some do's and don'ts. Okay. And I think we're doing well in time. So protecting your investments. The main thing you need to know about the stock market is it is being operated by human beings, and human beings they run on emotions. Okay, there are 2 emotions that govern Wall Street. Okay, one is greed and the other is fear. All right, so when you see, I'm showing this is a chart of the S&P 500. Okay, on the left you can see that the stock market is going up. That is greed in action. And on the right you can see it's coming down. That is fear. So those are the 2 emotions that govern the market. The reality is that most investors, they don't have the objectivity to recognize whether we are in the bear market or a bull market. Or even if they do, they often don't act in the right way, in the appropriate way. Okay, so this chart, I'm not going to spend too much time on it, but I'm just going to illustrate something to you. It's a very busy chart. So what it is, the black curve here is this S&P 500. Okay, and the blue portion below here shows you how much money is flowing in or out. When this is above this axis, money is flowing in. When it is below, money is flowing out. This is the total money that is flowing into the US stock market, whether it is from individuals or companies or professional investors, all the money. Okay, now look at this line that I drew here. You can see up to this point, people were putting money in. So money is going in. And then the market dropped, it recovered, it dropped. What did people start to do? Look here. They are withdrawing their money. But what is the market doing? The market says, well, I'm going to go up. And it continues to rise. By the time they realized it, and start to put money in, the market has already appreciated considerably. And again, you can go through this chart, more carefully, and you will see what I just told you repeated several times. The message from this chart is nobody can time the market right. Even professionals. Even professionals can't time the market right. How much less you as an individual. So let's look at some numbers from bear markets. Bear markets are when the market takes more than 20% correction. Okay. The 1929 was a very big one. The market lost more than 80% of its value. But that's, that is not the only bear market we've had. Over the years, we've had bear markets almost maybe every 10 to 12 years or so. There will be a bear market, okay? With different severities. For example, in 1929, if you had invested your money in the stock market, it would have taken you 15 years just to recover your money back. On the other hand, even more recently, we've had other bear markets. The market decline of 2008, for instance, the market lost over 50% of its value. So again, the message here is the market will go up and the market will come down. And the way you manage your risk is by making your asset allocation. This chart here shows you how, by making proper asset allocation between stocks and bonds, okay, you can reduce your risk of exposure. So let's take the aggressive growth. The aggressive growth invests more than about 75% in stocks and only 15% in bonds. Now, this aggressive stock will make, on the average, almost 10% per year. But guess what? Your worst return can also be 60%, which is very severe. On the other hand, if you are conservative and you put most of your investment in fixed income like bonds and only a small fraction in stocks, you will still make some decent return. But in this case, the amount you can lose goes down to just 17%. So you can decide your own risk profile between, and I will give you a rule of thumb that will allow you to do that very shortly, okay, between aggressive growth and conservative. So once you choose that, the rest is easy. So for the theoretical part of the discussion, before I now tell you how you go about doing it, I wanted to make sure we have, we have time to do that. Let me just check something here. Okay. So number one, I already talked about that, which is make sure you start saving and investing early, because time is your friend. Time is your friend when it comes to investment. Again, we've talked about having clear-cut objectives, keeping things simple. Be skeptical. Don't go for a hot tip that your friend tells you. Oh, I saw this thing. No. You're gonna get burnt. Peter Lynch, who was he was the money manager of Fidelity's Magellan Fund, very successful. He used to have a saying. He said, "Don't invest in anything you cannot explain to somebody in 2 sentences or less." In other words, keep away from complicated investments. Number 5 is make sure you have patience and you have discipline. Have patience and discipline. Don't rush to do anything. This one, just have separate equity and fixed income. This is just a recommendation. You don't have to follow that. And of course, we've talked about risk and making sure you match your investment to your risk tolerance. And again, keep your time horizon in perspective. Long-term stocks, short-term fixed assets. And then carefully select any assets in the category. Manage your portfolio objectively. Don't let fear and greed dictate your behavior. Remember, majority, as you saw in the chart I showed you shortly, majority is usually wrong. So don't follow the masses. Sir John Templeton was one of the greatest investors ever, and he said, when people are buying, when the people are selling, it takes a lot of guts to buy, but that is really when you can make the most money. And when people are buying, that is the time you want to sell. This comes from somebody who's an expert. And number 12, evaluate investments on a risk-adjusted basis. So those are your do's. And then there are also some don'ts. Don't try to make a fortune in a hurry, okay? You are more likely to lose what you have. And then don't try to, to predict the future. You hear somebody say, oh, I know where the market is going. Believe me, nobody knows where the market is going. The market is bigger than any single person. So nobody knows. You can't. And I always compare trying to short-term the market as somebody trying to cross a highway when cars are zooming at 70, 80 miles per hour. You're going to get killed. And that's what's going to happen to your investment if you attempt to short-term timing the market. This chart, you can take your time to study it, but I'm going to just, illustrate to you how, when you are not invested in the market, how you can get hot. So on the very first bar, so this basically is putting $10,000 in S&P 500 from over the space of 40 years. Okay. If you are invested for all of those days, you end up with about $1 billion. But look at the next chart. If you just miss 5 days, 5 of the best days, guess what? Your investment turns suddenly to just over $500,000. Now, it's still a lot of money, but it's not as much as you will have made. I'm not going to go through the rest of it. The point of this chart is trying to, go in and out of the market doesn't work. Remember, if you're not at the table, you're probably on the menu. And again, don't speculate. If you want to speculate, hey, go to Las Vegas and gamble. But stock market is not intended for you to speculate. And don't try to jump from one asset class to the other, because that simply means you can't make up your mind. And again, don't be deceived by the past performance of a particular fund. Something that, say, makes 20% this year can suddenly make, nothing next year, or even lose money. And don't put 10%, more than 10% of your assets in one stock. Now, it says one stock. If you are putting money into ETF, yes, you can put a large amount. I've already explained why you don't want to do it for individual stock, because they are volatile, okay? And of course, again, don't be influenced by day-to-day fluctuations on the stock market. And don't panic when the market seems to fall apart. Usually it will recover. If you panic, that is when you actually lose money. Don't be discouraged by setback. Even the best money managers, they make mistakes too. And remember, it's slow and steady that wins the race. So this is the theoretical part that I've given you. I know I gave you a lot of data, but I know it's going to take time to sink in. But do you have any questions at this point on this part? Okay, so now let's go to how do you put this in practice? So everything I've been talking about, this is all theory. How do you put it into practice? I'm going to give you some portfolio examples, and then account types, and then some sample investment plans. Constructing your portfolio, we use a pyramid structure. The first thing is you begin with your objective. Remember when we talked about SMART objectives? In this case, this person says, I want to have $1 million in 30 years. Okay, that's an objective. Then you decide how are you going to make it. This person says, I'm going to be putting in $300 per month, and I'm going to be putting it on S&P 500, which is going to yield me 10%. Actually, in this case, this person wants to put 60% in equity and 40% in fixed income. I will tell you right now, by the way, there are many more steps, but I can tell you right now, your decision on step 3 is going to determine your return to a large extent. Let me show you the other parts. All these other parts, these are just details. These are just details. This is where the rubber meets the road, where you determine how much you put in equity and how much you put in fixed income. The last step there, which is rebalancing, that one is very important. So I'm going to talk about that in a few more slides. Okay. But the point is, what you decide to put in equity versus what you put in fixed income is going to determine the bulk of your return. So now let's go through some portfolio examples. I've already told you these 6 ETFs. They contain most of what you need to make your investments. Okay. There is a rule of thumb. Okay. What it is if you take your age, okay, take your age, whatever your age is, that is the percentage you want to put in fixed income. And when you deduct it from 100, you put that balance in stocks. That is a rule of thumb. It's been around for a long time. Let's look at some examples. Somebody who is young, 30 years old, you know, they will want to put about 30% in fixed income. In this case, BND, which is the total bond fund, and 70% in stocks, SPY, which is S&P 500. Now, why does this rule of thumb work? The reason it works is this. When you are 30 years old, you have a lot of time for you in case the market goes down to recover. That is why you can afford to put 70% in stocks and only 30% in bonds. Okay? And I illustrate with amount here. And by the way, you don't have to have gazillion dollars to invest. Let's say this person, you know, wants to put $100. The person will just put $70 in SPY, $30 in BND. Case closed. Okay? So you don't need a lot of money, but you got to start early. Now, this is a rule of thumb. Does it mean you have to do it exactly? No. Let me illustrate this again. This guy who is 30 years old, he could say, well, you know what? I want to take more chances because I know I'm not going to touch this money for a long time. I'm going to go to 80% in stocks and only 20% in fixed income. That is okay. That is his risk level. On the other hand, he could say, well, I think this 70% is too much for me. I'm going to back it down. So he could say, I'm going to put 60% in stocks and 40% in bonds. So it's a rule of thumb. Once you do this with your age, you can go, I would say, plus or minus 10, even plus or minus 20 if you want to. I wouldn't push it past that because there's a reason it's made, this rule of thumb was made. It is to protect you. Okay, so that's one example. Now let's go with somebody who is middle-aged, 60 years old. Okay, in this case, this person doesn't have as much time as somebody who is 30 years old. So this rule of thumb says they put 60% in fixed income, BND, and 40% in SPY. What that does is that even if the market were to react, the amount they are going to lose is going to be tempered because they have a large amount in BND. Okay, so but again, this person can say, well, even though, yeah, sure, I'm older, but I want to take more risk because I know I'm not going to touch this money for the next 5 or 10 years. So I want to take risk. So this person can say, well, I'm going to go up. Instead of 40% in stocks, I'm going to put 50%. It's okay. It's okay. So it's not a hard and fast rule. It's a good place for you to start. Okay? And then use your own risk tolerance to determine your final number. Okay? Now, I mentioned that I'm going to talk about rebalancing. So let's say you've already decided how much percentage you're going to put in stocks versus fixed assets. Now, let's assume you started with $2,000. Okay? You put, let's say in your case, you decided to put 50% in bonds and 50% in stocks, $1,000 each. Okay? At the end of the year, your stocks, you hope, has appreciated by something like 10%. So you are now $1,100 in the stock. Your bonds, on the other hand, again, this is to be expected. Bonds perform less than stocks. So this should not surprise you. It's appreciated by 2%, and you have $1,020. So the new total now is $2,120. Now, if you don't do anything, your portfolio is now no longer, adhering to your original 50-50 division, because now you have more money in stocks versus bonds. So what you do, you rebalance. And here's how you rebalance. To rebalance, you move $40 from the stock to your bonds, so that now both of them, each of them has $1,060 and $1,060. That way you are back to 50-50. So that is what rebalancing is. It's basically moving your assets to reflect your asset allocation. Whatever you decided is going to be your asset allocation. Now, do you have to rebalance every month? No. Once a year. Once a year you rebalance, that's okay. So this is not something you are going to be, looking at, oh, my portfolio is, but no. Once a year you look at your account and then you rebalance. It's not. Okay. Now, how do you go about with this account? And I'm going to show you for real, just to show you an example of how easy it is to do this. There are 3 different types of accounts. Taxable accounts, we call them individual accounts. Tax deferred accounts, these are retirement. The last 2 are retirement accounts, tax deferred and tax exempt. Okay. So taxable accounts, you can use them to hold, stocks, bonds, mutual fund, or ETFs. The important thing to realize about this is that you have to pay taxes on any capital gains that you realize. Remember, the key word here is realized. Let me give you an example. Let's suppose you put $100 in SPY, okay, at the beginning of the year. And SPY, appreciated, and at the end of the year, it became $120, okay? So you've made $20 in capital gains. Now, if you don't sell this, that SPY, you don't pay capital gains, okay? You only pay capital gains when you sell that security, which in your case is SPY. So if you sell it, and which means you now make $20 profit, Uncle Sam wants to get a share of your profit. And I think I have a chart that shows, yes. So these are the capital gains you're going to be paying, at least by 2024 figures, 0, 15%, and 20%, depending on your income. Okay. So the point is that you pay capital gains only when you sell that asset. The capital gain is not, you don't make capital gains until you sell it. So let's move on to the next. Tax deferred accounts. They could be 401ks, 403bs, or IRA accounts. There's something I need to mention here. If there is anyone here, you are working for an organization that matches your 401k, make sure you match it. Make sure you pay into it. Because if you don't, you are throwing money away. When I was at GE used to match our 401k, I think up to 3 or 5%. So if you put $100 in, up to 3%, GE will put $100 in for you. So if you have such a plan wherever you work, make sure you contribute so that you get free money. Okay. So anyway, back to the tax deferred accounts. This is money that you put into a retirement account, and you don't pay taxes on it until it is withdrawn. That's why they are called tax deferred. The other type is Roth IRAs or Roth 401ks. The difference between this and the previous one is that you make contributions to them with after-tax dollars. After-tax dollars, meaning that you pay your taxes upfront. But once you pay those taxes, you don't pay any taxes, even when you withdraw them when you've already retired. So those are the three different accounts. So now here are three investment companies that I'm familiar with. Now, do you have to go with these ones? No. There are tons of other investment companies. These are just the ones I'm familiar with. And just to show you how easy it is, maybe I will do that. Yeah, somebody remind me to do that at the end. I don't want to stop the flow of the thing, but somebody please remind me to show you how you do this on I think I have something on the Schwab account, how you open an account with any of these companies. So that's how you do it. You open an account with these companies and you start making your investments. Okay, so I think yes, Daddy Tosin and Mommy Tosin are still with us. So I'm glad you are, because I want to mention a few things relevant to Canadians who want to invest in the stock market, in the US stock market. There are no citizenship barriers. Anybody can invest in the stock market. We have in the US stock market, we have people investing from China, from from other parts of Asia, from Europe. Everybody wants to get a piece of the US market. So citizenship is no barrier. The only thing is you have to consider currencies, of course. Since US stocks are traded in US dollars, you may need to convert to Canadian dollars. Okay. And then the benefit for Canadians is that you have your own stock market. But if you invest in the US stock market, you get more diversification. And secondly, over time, the S&P 500 has appreciated more than the Canadian market by about 2 to 3 percentage points. So it's not insignificant. So performance-wise, it helps for you to be invested here. Just so you know, you won't be alone. I found that in February earlier this year, Canadians invested almost $30 billion in US stock market. So you won't be alone if you invest in the US stock market. And then how do you do it? You can use one of those companies that I showed. Okay, they too let you buy and sell US stocks or ETFs. On the other hand, you can also do it through Canadian brokerages. I just got a few here. These are all Canadian brokerages. The advantage with the Canadian brokerage is that they will handle all your stuff in Canadian dollars. Okay, so that may be an advantage. But you don't have to go with the Canadian brokerage. You can go with American brokerages as well. The other thing of course you have to be aware of is tax implications. Okay, your capital gains on the US stocks has to be reported in your Canadian tax. They said TFSA gains are tax-free. I'm sure you guys are aware of what TFSA is. Good, thank you. So, but those are the only implications for you, for Canadians investing in the US stock market. But other than that, you can invest in the US stock market. I'm going to close with 3 sample investment plans just to whet your appetite. Okay. Here is a sample investment plan number 1. Okay. Here is an individual puts $1,000 to start, just $1,000, okay? And they invest $100 per month, every month, okay? For the next 5 years. Based on what we now see as the average of return on the stock market, what they're going to end up with is about $9,000. Now, I want you to keep your eye on this pie, okay? So the amount that they invested, their contribution will have been $6,000. And the interest is over $2,000. So the red part here is the interest. So 24% is what they make in interest. 65% is what they contribute. Nothing to write home about. Okay? Keep this at the back of your mind for the next chart. See what happens when this same person, again, this is the same person, but they continue to invest this for the next up to 10 years instead of 5. See what happens. That amount has now grown to $22,000. And of this, 42% is from interest. So roughly half is what this person contributes, and the rest is coming from interest. It gets even better. If this person leaves it there for 20 years, see what happens. Now, almost 70% is coming from interest. This person, by the way, ends up with almost $80,000. And only one third is what this person contributes. The point of showing you this sample investment is that you don't need a lot to start investing. Let me tell you something here. If some of you may already be doing what I mentioned in this webinar, if you're already doing it, I say kudos to you. For those who are not, the worst thing you can do coming out of this webinar is nothing. Okay? So, do something. Do something, even if it's something small. If it's $50 you can put aside every month, do it. But you need to do it regularly in order to see the results. This is not something you're going to be looking at in a few months. And but when you do it, I hope those examples I showed you will convince you that when you keep this money on over the long term, the benefits are huge. Okay. Any questions? Okay. Any questions at this point before I ask you my question again? Okay. Wale has. He just texted. Okay. Let's just see. Thank you, Wale, for on the chat. Where presenter is it? Okay. All right. Thank you, Wale. Daddy Bukun has a question. Go ahead.
Thank you for your presentation.
You're welcome.
Just to remind you, you said you will explain to us how to open those accounts that we should remind you.
Thank you. Thank you for reminding me. So I'm going to do that right now. So I'm going to stop sharing this screen, and I will go to my let's escape. Wale, if you could go back on mute, because we're hearing some echo. Yeah, thank you. Now, so let me now go to the Schwab, and then I'm going to present that screen. Okay. Let's go to Schwab. So let's share. I'm going to share this, the window, and there it is. And share. Okay, can everybody see Schwab? Okay.
Yes, yes.
Thank you. So this is what you see if you just go to schwab.com. And again, remember, I'm not telling you to just do Schwab. You can do it in Fidelity. You can do it in Vanguard. I'm just going to use Schwab to illustrate to you how simple it is. So here you go. They are already presenting to you all the options that you have that I just went through. Rollover, they even explain to you what it is. Roll over your prior retirement from a former employer. Roth IRA, remember I mentioned that? Plan for your future with a Roth IRA. Traditional IRA, plan your future. Now, if you are not investing for retirement, the one you are going to choose is individual brokerage. But if you and your spouse want to have this account together, you will go with joint brokerage. Okay? So these are the various ones that you can invest in depending on your situation. The first three, if you want to invest for an IRA, which is specifically for retirement, okay, or individual brokerage, which is just for your own use, or joint for you and your spouse. Okay, so I'm going to click on the individual brokerage. I'm going to pretend like I want to open an account, again, to show you how easy it is. So let me click it and let's see what happens. All right, it's coming out slowly. All right, so they are asking me questions. What can you do with a brokerage account? Blah, 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 blah. Already, let me point out something to you. So you can see here, it tells you you can buy and sell stocks, mutual fund, ETFs, and other investments. Trade or invest for the long-term goal, just as I told you. Here is the part I like. What are the costs of opening a brokerage account? Zero. Zero. So it costs you nothing to open an account. And by the way, you don't even have any money to open the account. I mean, how else easy can it be? You don't need any money to open an account. Okay. Now, you will have to give them, they are required. SEC regulations require for you to give them your social security. And again, when you are doing this with a reputable company, any of those big companies, you should not be afraid of giving them your social security. They need this because they have to report what you earn to IRS. So that's why they need your social security number. Okay. And then they ask for other, your employer's names and address. And then you just click get started, and you fill in the forms, your name, your contact information and so on. I'm not going to fill it here, but it tells you the point of this is it is as easy as 1, 2, 3. You can do it again in any of those big brokerage companies. So thanks, Daddy Bukun for reminding me. Any question on this part of how you open your account before we move on? Okay. All right. I'm going to stop sharing that screen and go back to my slides. I'm going to go back to my slides, which is the PowerPoint. Let me put it back up first from current slide. All right. And then we're going to say window, and it's this one, share. All right. So that is the presentation. Now, remember the question I asked you when we started. I'm going to ask you that question again. And then you're going to vote again. 1 vote per person. I'm going to ask one by one. Again, just do it by using your raise hands signal. So I'm a long-term investor. How frequently should I check my portfolio? A, as frequently as I can on my mobile phone. Any hands? Nope. Daily. Any hands? Nope. Weekly. Any hands? Nope. Monthly? Any hands? Nope. Quarterly. Any hands? Nope. Yearly. All right. Now I see everybody. Everybody. Well, you know what? I'm going to congratulate you all. You passed. That's my test as to whether people really got my message. Okay. The point again is, once you make your asset allocation, you don't need to be watching every move that goes on in the market. Once a year is okay. All right. That is the key message. And I'm glad everybody, by the way, in other classes I've taught, usually they get it too. So I give you kudos for that. All right. And so let me, to illustrate what I just told you. This was, remember I told you I built this webinar when I taught this as a class based on lessons I learned. As one of my friends would call it, I learned from the school of hard knocks. Okay, I made mistakes and I said I got to put these things down so other people don't make it. Here is an example of what I'm talking about. I used to have an account which was my retirement account, and I very rarely touched it. Maybe I will look at it once a year. And then I had this account. I used to, I trade daily. And guess what? The one that I was checking daily, that was the one I barely made anything. And the one I left intact, that I don't look at it other than once a year, it was appreciating at 10%. So this should be a warning to you about not being too active in the in your accounts. All right. So now I've given you my spiel, and I usually like to get feedback from my students. So I have a couple of questions. What's the most important lessons you've learned in this class? And is there any specific action? We're just going to go around. I see actually before we do that, several people are raising their hands. I don't know if it's from, please put your hands down if you didn't mean to raise your hands, if it's for the previous poll. Yeah, put them down. Okay, then I will recognize. Okay, so now these are legitimate raising of hands. So I'm going to ask them one by one because that means they have questions. Let's begin with Daddy Bukun. Please go ahead with your question. Unmute yourself, please. Yes.
Okay. Yeah. Not really a question. I just want to, first of all, to thank you for this initiative and the educative this thing you have given to us. Actually, I'm just hearing for the first time that it is better for someone to think before you dive into these things, because exactly. I've had a lot of these things. Yes. But my concern is so I don't put my number one. I don't want to put my eggs in one basket.
Exactly.
At the same time, I don't want to remain adamant as if to ignore the ideas. But this evening you made it more clearer, and I can understand the differences between these stock and the bond, because it wasn't clear before, but it's very clear now. So I just appreciate that. Yeah, very good. I just appreciate that.
Very good. Thank you, Daddy Bukun. Thank you very much. And Jumake is raising her hand. Jumake,
yes,
go ahead.
Sir.
Go ahead.
Yes, sir. Thank you very much, sir. I have a question.
Yes.
Like when you open the account.
Yes.
In the individual brokerage accounts.
Yes.
Am I going to indicate the number of years that I want to leave the investment for?
No.
Or have you just buy the ETF?
No, you don't. You monitor it by yourself.
Yeah.
Okay. So you put it in there. That is, remember one of my do's when I said you need to be disciplined.
Okay.
Part of it is you see, keep in mind, you see the stock market is a free place. It's the freest market in the world.
Okay.
And so they allow you to do whatever you want with your money. Let's say, let me give you an example.
Yes.
Suppose you put $100 in today.
Yeah.
Okay, especially if you put it in an ETF.
Yeah.
You can decide tomorrow, I don't want it anymore, and cash it. Nobody's going to stop you.
Okay.
But it's up to you to know what you are doing it for. You say to yourself, I'm not going to touch this thing for the next X amount of years.
Yes. Okay. Okay.
So
Thank you, sir.
that's how you do that.
Okay. Thank you, sir.
Very good questions. You're okay. By the way, I'm glad you were finally able to join.
Yes, sir. Thank you, sir.
No problem. No problem. All right. Any other questions? Jumoke, you can put your hand down since I've already recognized you. All right. Thank you. Any other questions? Now I will leave it open. One by one, each person can express what, if you've learned anything from this. We've already heard from Daddy Bukun. So, but others, let's hear what you have to say. Martin is raising his hands. Martin, you go first.
Okay, Doctor, thank you very much for your presentation.
You're welcome.
Very impressed. I have a question.
Yes.
What do you think that will be the future of this American market in particular, or the global market?
Okay.
In the near future,
Okay.
With all the disruption.
Good.
Excellent
question. Excellent question, Martin.
In terms of geopolitics at the moment.
Yes. Excellent question. So I'm going to answer it this way. You see, if let's say you are interested, you put your money in the market, and you are going to need it over the next year. Remember one of my slides, and I said, if you're going to be investing less than 5 years, don't even think of the stock market. Are you following me?
Yeah.
So once you go past that 5-year limit, all these things, geopolitical, tariffs and all these things, they are noise. They are pure noise. They're not going to affect your investment whatsoever. I remember when the first tariffs were imposed, the market took a nosedive. And then when they were removed, it went back up. The market has already recovered, what it lost before. So that is the beauty of investing over a long term. You don't have to bother about this, what I call noise. It's just noise. Did I answer your question, Martin?
Yes and no.
Okay, go ahead. Ask further.
I'm sorry, but I don't want to be.
No. Yeah, ask because other people may have similar concerns with you. Go ahead. Ask further. Let me see if I can help.
Someone that is pessimist, right?
Well, go ahead.
Yeah, okay. The situation, the global economy.
Yes.
Correct me if I'm wrong. The situation of the global economy at the moment have never happened before. It is the first time, according to me,
yes,
that the capitalism system that have been put on place since Bretton Woods have facing a serious challenge.
Got you.
Based on what is the trend now about the de-dollarization and the BRICS, the fight. That tariff is just part of it. It's just part of the.
So.
What is your personal opinion? I'm not.
Yes.
Everything you said. Technically, I have nothing to say. I have to just say congratulations. I told you I was impressed.
Yeah. Well, let me say. So Martin, let me answer you this way. Okay. Have you heard of Warren Buffett?
Yes, of course.
Good. He's probably arguably the greatest investor ever. And let me quote him. When people say, well, these times are very different, he has a saying, don't underestimate the US market. People who underestimate the US market over decades, they've been burned. So remember, wars are not new. You know, I mean, I sometimes come across old newspapers, and you will see people have been fighting for goodness sake. Human beings have been fighting. The wars are just different. Okay, tariffs. By the way, even these tariffs we're talking about, tariffs were imposed. I can't remember which president in the 30s. So the point is, there is nothing new under the heavens. Nothing. So all this turmoil you are talking about, there will always be turmoil in the world. The world has never been a place where everybody is you know, holding hands and singing kumbaya. No, the world has been a very violent place. You just have to go back in the history. So you can't, you know, people will say, oh yeah, this time is different. No. When you underestimate the market, you get killed by the market. So I'm with Warren Buffett in that don't underestimate the U.S. market. But again, the point is this, Martin, just to be more specific. That is why, no, I am not advocating putting 100% of your money into the stock market. That would be foolish.
No, I'm not talking about me.
So but the point, Martin, is this: when you have the right asset mix, the right asset mix of stocks versus fixed assets, you protect yourself. That's the way you minimize your risk, not by staying completely away from the market. You choose how much percentage you want to put in, and then that protects you. So, let's say, suppose the market nosedives 40%. If you have enough assets in fixed income, you may lose 10%. Big deal. Big deal. So that's how you protect yourself. It is by how much asset you put in stocks versus bonds. I hope that helps you, Martin.
Yeah, I am not against investments. That's not.
Okay.
Don't get me wrong. Don't get me wrong. You know.
Okay.
I'm a businessman.
Got you.
And I cannot be a businessman and be against.
Got you. Good.
Well, my concern is not about this. My concern is just about what I used to tell my sister Sigi.
Yes.
That, the world will never be the same again.
Yes. Go ahead.
Am I wrong?
You know, you may be right. You may be right, but you see, let me tell you one little joke or anecdotal information. I remember I was watching one of these, nature series on TV, and I saw there where they mentioned how our solar system, is going to basically burn out. And my youngest son, and I told him, I said, I watched this program. I said, do you know what's going to happen to our solar system in 500 million years? He didn't let me finish. He said, it's going to collapse and burn up. So our solar system is going to collapse in 500 million years. But what do we care about 500 million years, for goodness sake? You know what I'm saying? None of us is going to be here in 500 million years. So, I mean, again, that is it's kind of facetious. But the point I'm making is that, yes, the US may be in decline. That may be true. But the rate at which decline is happening is not such that it's going to affect you and me, ordinary people that are just trying to make, our little buck.
I did not want to say the key word. You said
I know, I know, but all I'm saying is that we can't be concerned about certain things. Geopolitical events, they happen all the time. Remember this slide I showed you. Remember when Brexit happened? Everybody thought Brexit, that's the end of the UK. And they recovered. So, the point is that there will always be these events that can, that tend to shake the world. And somehow, we keep chugging along. So, but thanks for your input. So, but let's give other people opportunity to also voice their opinion. Anybody else wants to chime in? Just raise your hand. Okay, Shaggy, go ahead.
Yes. Excuse me, I know that we're talking about the US market.
Okay.
But since we're all kind of, I want to assume, mostly Nigerians.
Yes.
I will talk about my experience with the Nigerian market.
Yes.
The volatility of the market in the US.
Yes.
We know that it goes up and it goes down.
Yes.
Anything can happen with stock.
Yes.
But in Nigeria, many years ago, I think now going on 30 years, I invested in stock market because I was in the banking industry.
Yes.
And most of the stock of industries that I invested in packed up and left the country. Some died completely.
I think I heard something like that before. Yes, go ahead.
Okay, some died completely.
Yes.
The various factors that led to that were, I don't know if we can say expected or unexpected, but it crashed the market. There are basically no functioning industries in Nigeria. I don't think there are more than like 10 or 20 anymore. Some moved to nearby countries like Ghana and so on. So the stock that you have with those ones are still okay. My question is, when you have situation like that in Nigeria, being patient, which is something that I would say I took away from this webinar. Being patient for change to come when the stock will rise and appreciate and so on. We're almost waiting indefinitely.
Yes. So Shaggy, good question. Because this is not for people in Nigeria. This is for people in the diaspora. Nigerian stock market is a different ball game entirely, Shaggy. It's a different ball game. I won't be. This presentation is not valid for the Nigerian situation. Okay, so it is strictly tailored to to the U.S. stock market. Okay. Now, don't get me wrong, Shaggy. even in the U.S., there are stocks that vanish overnight. And it has happened to me before. Companies that I invested in suddenly vanished. There was a company called Enron. Enron disappeared overnight. So it can happen here. But you see, if you look at the slides I was presenting earlier, that's what I'm saying. Don't put it in one stock. Buy ETF. When you buy ETF, you are buying many companies. The chances that 100 companies are going to go bust overnight is zero. You follow me, Shaggy?
Yes, I do.
So that's the way you minimize your risk. So it's not like companies here can't disappear. Yes, they can. But when you own an ETF, an index fund that invests in like 100 companies, yeah, one of them goes belly up. Who cares? Okay, so that's how you do that. Did I answer your question, Shaggy?
Yeah. For Nigeria.
but again, Shaggy, don't compare apples and oranges. You comparing the US and Nigeria, those are apples and oranges.
Yeah, I know, but I'm very worried about myself. My stock in Nigeria and everything has disappeared, and then we now talk about patience, and I can't decide.
But Shaggy, I can't speak for Nigeria. I can speak for the US, but not for Nigeria. Yeah. So don't let your experience in Nigeria taint your view of the US. But again, don't get me wrong. You need to make your asset allocation to suit your risk. Okay.
Very clear.
Good.
Very clear. Thank you.
All right, you're welcome. All right. I see. Okay. So Wale says it's noisy. Let me just read Wale's chat note to see So it's okay. So Wale says it's noisy where he is. Yeah, that's why he's sending this note. So the things, okay, this is Wale speaking. Lessons learned from the presentation. Start investing as early as possible. Minimize your risk by investing in different funds, and long-term investment is much better. Thank you, Wale. Those are excellent lessons that he's taking out. Anybody else wants to add to lessons learned or questions? Okay, Ronke,
Yes.
go ahead.
Thank you very much, Uncle. This was really an eye opener. I think my takeaway is also that you need to start investing early.
Good.
That long-term investment is really much better than short-term investment.
Exactly.
Now, here's my concern, or here's my question.
Okay, go ahead.
For people who are nearing retirement age,
yes,
and they also want to, invest in one way or the other, what would you recommend for such?
So that is where, so Ronke, that's an excellent question. And that is where, remember the rule of thumb that I gave. That is where it comes in handy. So once you are nearing retirement, you need to put only you need to put a smaller percentage of your investment into stocks, because you do not have as much time. So that's how you reduce your risk. So again, use the example I gave. If it's somebody is 60 years old, then that person will be putting 60% in bonds and 40% in stocks. Okay, so now that obviously is not going to make as much money as somebody who puts 70% in stocks, but it minimizes the risk. Okay, it minimizes the risk. And as I mentioned, you don't have to go by that formula only. You can go plus or minus 10% or even plus or minus 20, depending on how much risk you believe. The key thing to keep in mind, Ronke, is think of when you are going to pull money out of this account. If it's 10 years, you can afford to put more into stocks. But if it is 5 years, then you put less. So that's how you do that. It's by the amount you put, the percentage you put into stocks versus bonds. Does that answer your question, Ronke?
Very, very much, sir. Very much. I was also thinking along that line, good, and good. Yeah, you just confirmed it.
All right. Okay, you're welcome. All right. Others, anything you want to share with us in terms of what you've learned, or what action you are taking? Looks like everybody has said their piece. And I think I have one more. Hold on a second. I have, okay. Isabel is thanking me. Thank you, Isabel, if you're still online. Thank you very much for attending. Really appreciate it. I'm going to go one more. Okay. So now, as I mentioned again, credit goes to Ronke and Shegi, because they are the ones, they always ask me questions, and then so that's how I thought about having this this webinar, and clearly many people have benefited. But along that line, what has been going on in my mind, I have been thinking of setting up a LinkedIn group, which would be a kind of global mentorship of sharing ideas, basically networking, exchanging knowledge, sharing ideas, and discussing relevant topics. I mean, it doesn't have to be investment, it could be people, involved in careers and stuff like that, because I've mentored, just as I've been mentored by other people, I've also mentored many people. So I thought there should be a forum where we can, gather people and exchange ideas. So that's what I have in mind. What I'm going to ask you is this: if you are interested in becoming a member of this mentorship network, either email me or text me. Or text me, just tell me, hey, include me in the global network, then I will know to include you. So depending on how much interest we have, then I will set up and I will let you know whatever happens. But that is the that is the idea. Did anybody raise their hands? I don't think I saw anybody. So these are, and finally, I have some references here. Okay, thank you. Wale, I already have the first member. Wale has already asked me to include him in the network, and I will. So Shaggy is raising her hand. Shaggy, go ahead. Shaggy, go ahead.
Yeah, I'm raising my hand to request that you kindly include me in the.
Oh, okay, thank you. So you will be included. You know, and others you can let me know as well. These are a couple of references. Martin, go ahead. Martin?
Oh, just to be included.
Okay, thank you. You will be included.
We are going to make some money, right?
Sorry?
We are going to make some money, right?
Remember, like I said, I will educate you, and your job is to use the education I give you to make money.
Every money we make, you just let me keep it.
Very good. So, in terms of references, when I originally... Daddy Tosin is raising his hand. Go ahead, Daddy Tosin.
Yes, I would like to be included too.
Oh, thank you. Thank you. You will be included. And Ronke too is raising her hand.
Yes, sir. Yes, sir.
Okay, so I will include you too. Very good. Very good. All right, thank you. That's a very good level of interest. And so again, the last slide here I have is just some, Fidelity has very good, if you want to learn more about the ETFs that I talked about, go to fidelity.com. There's a lot of information there. And then the book that originally built this around is called Building Wealth with Mutual Funds, but it's now outdated because he uses mutual funds, whereas I advocate ETFs. Okay, and that is it. So I hope you've learned enough to be able to build yourself some good nest egg. Ronke, are you still raising your hand, or is that from the previous?
Oh, that I'll take it off.
Okay,
I'll take it off.
All right. So again, I wish you happy investment. And by the way, once I set up, yeah. So Jumoke, go ahead.
No, I don't have anything to say.
Okay. All right.
Yes.
All right. So, by the way, if you have follow-up questions, feel free to email me. The best way to reach me is by email. Sometimes, Nigerians send me WhatsApp, but sometimes I don't check my WhatsApp for several days. But also, once we organize the global network, it will be a good forum for people to ask further questions that other people may have. So that will also give you give us an avenue to do that. I'm going to stop sharing this screen, but I want to thank all of you for attending this webinar. It's been fun for me, and from the feedback I've received from you, it looks like you learned something. Remember, all I have done is planted some seeds. So hopefully some of them are going to germinate, and you'll be able to do good things with what you've learned. So again, thanks to everybody.